Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to video number 7 of my 10-part video series on tax planning for the year end 2024. As mentioned in video number 1, starting January the 15th, 2025 and running through April the 15th, 2025, I will be hosting a 2024 tax return preparation class. There is no better way to learn tax planning than from inside the tax return. So this is where all the action is going to be with me and the channel for the 2025 tax busy season. There is an all new video FAQ on the class, and the link to that can be found in the description below this video. Alright, in this particular video number 7, we're going to be talking about QCDs, which are Qualified Charitable Distributions from your traditional IRAs. Now starting right here with pop quiz number 1, what is the maximum QCD that can be made in 2024, and how old do you have to be in order to make a QCD in the first place? And the answer to that is right here. You can make up to $105,000 in tax-free charitable donations during 2024 through Qualified Charitable Distributions, or QCDs. That, by the way, is an increase from the $100,000 limit, which had been in place for many prior years, but now QCDs are indexed for inflation starting in 2024, so the amount will continue to increase each year. And also, to finish off answering the question from above, IRA owners who are age 70 and a half or older are those who are eligible to make qualified charitable distributions. Okay, pop quiz number 2. If you are age 73 or older in 2024, can a QCD satisfy your RMD requirement? And the answer to that is yes. For those age 73 or older, QCDs also count toward the year's required minimum distribution. All right, next up, pop quiz number 3. If both spouses are age 73 or older, can each spouse do a QCD from their IRA? And also, does doing a QCD require you to itemize deductions? And the answer to that is here. Each eligible IRA owner can exclude up to $105,000 in QCDs from taxable income. Therefore, married couples, if both meet qualifications and have separate IRAs, can donate up to $210,000 combined. And no, QCDs don't require you to itemize deductions. Okay, pop quiz number 4. Do you take a deduction on your tax return on either Schedule 1 or as an itemized deduction related to QCDs? And the answer is no, you do not take a deduction on Schedule 1 or as an itemized deduction related to QCDs. The way it works is like this. The full amount of any IRA distribution goes on line 4A of your tax return, and then you would enter a 0 on line 4B if the full amount of the distribution was a QCD, and you would mark your tax return as such. Okay, let's do an example. Assume you had to take a $75,000 RMD in 2024. Further assume you decide that of the $75,000, you will make a QCD of $30,000 to the charitable organization of your choice. In that case, your return would look like this. So remember what it said right here. The full amount of any IRA distribution goes on line 4A. So here is line 4A, IRA distributions, and in this example, we would have $75,000, the full distribution on there. Now here it says enter 0 on line 4B if the full amount of the distribution is a QCD. But in the example that we are doing, we have indicated that the QCD is only $30,000 of the $75,000. Therefore, what would go on line 4B, the taxable amount in this example, is the difference between $75,000 less $30,000, which would would be $45,000 of taxable distribution. And then right here it says mark your tax return as such. And the way you mark the tax return is you write QCD right here on this line. And by doing that, the IRS will understand that the difference between these two numbers relates to a QCD. At least part of the difference relates to a QCD. It is certainly possible there could be an additional reason baked into this difference that does not relate to a QCD. But nonetheless, if there is any QCD at all involved, you mark your tax return like this. That's the procedure that the IRS wants. Okay, pop quiz number 5. Can you distribute $105,000 to yourself, then hit the casino, win big on blackjack, walk out with $200,000, drop off $105,000 at your favorite charity, pocket the remaining $95,000, and then claim a QCD of $105,000 on your tax return? And the answer is no, you cannot do that. QCDs remain tax-free if sent directly to the qualified charity by the trustee, in other words, by your broker in most cases. So the minute you take a distribution from your IRA into your personal possession, it no longer is eligible to be a QCD. It has to go directly to the charity. Next up, pop quiz number 6. Can a QCD go to a donor-advised fund? And the answer is no, a QCD cannot go to a donor-advised fund, and a lot of people get confused on this point. In fact, I can't find anything at the IRS which specifically says this, which is probably one of the reasons people get so confused. So we're going to go with what the big boys have to say about this. Starting here with Schwab Charitable, can you make a QCD to qualifying public charities from a traditional IRA? Yes, excluding donor-advised funds. Now down here with Heritage Financial, can I send a QCD to a DAF? And the answer is no, a QCD cannot be sent to a DAF or private foundation. Next up, Fidelity Charitable. Currently, QCDs cannot be made to donor-advised fund sponsors. And finally, just for good measure, we'll throw in Harvard alumni. Are there any restrictions on qualified charitable distributions? A QCD cannot be given to a donor-advised fund. Now, you can give gifts of appreciated stock held in a regular brokerage account to a donor-advised fund, but not QCDs from IRAs. By the way, if you've been watching this video and you're like, what the heck is a donor-advised fund? Well, I do have a video specifically on that. In fact, I have 3 videos you may want to watch related to charitable giving in general, which are Charitable Giving Part 1 right here, which talks about charitable giving as a tax strategy in general. Charitable Giving Part 2 right here, which talks about the charitable bunching strategy. And then the video most relevant for this discussion right here, Part 3, Donor-Advised Funds. And you can find those videos by just searching on YouTube for Number Crunch Nerds Charitable Contributions. Okay, pop quiz number 7. How do we get a QCD populated into the personal tax planning template? Let's go check that out. Okay, so we're in the personal tax planning template, and I'm right over here on the Roth Conversion Tax Strategy tab. And if you recall from the previous video in this series, we had made a column right here for IRA to HSA rollovers as well as for QCDs, and we're going to enter the numbers here as negative numbers. So remember that if we're going to enter a QCD in this column, it has to be in a year where we are 70 and a half or older. So let's just assume for this example that this person is over 70 and a half by the end of 2029. We're going to enter a QCD right here of $105,000. As I mentioned before, that will be indexed for inflation, so by the time we get to 2029, this number will be higher. So we can figure out a way within the personal tax planning template to project out the 105 by a particular growth rate just to estimate what it would be in future years. But for now, I just want to focus on the concept of doing a QCD at all and how it's incorporated into the template. Now, I don't know if you noticed, but this number right here, the first RMD for this particular person, was a higher number before I entered the 105. Let me take the 105 back out. We can look down here, 148 on the RMD, 152, 156. Let's put that 105 back in, and now we have dropped to 143, 148, 152. So as we have talked about on a number of occasions before, if you choose to do QCDs, you not only have the ability to support your favorite charitable organizations, but because you are reducing your IRA balance by doing this, you are thus reducing the amount of RMD income that you will have to deal with in future years. And of course, just in case this wasn't clear, the HSA rollover is a once-in-a-lifetime event, but the QCD can be done annually up to the limit. So if I type in some more right here, just leaving the amounts at 105 for simplicity, you will see that these RMDs right here continue to be decreased. So now the question is, does anything else have to be done with this 105 right here on this page or somewhere else within the personal tax planning template? For example, does it need to go right here in our other income and adjustments section, which relates to the Schedule 1 on your tax return? Or does it need to go down here in the charitable contribution lines as an itemized deduction? And the answer to that was right back up here in pop quiz number 4. Do you take a deduction on your tax return on either Schedule 1 or as an itemized deduction related to QCDs? And the answer was no, as we went over before. The tax benefit that you are getting by doing this is already incorporated into the number right here in 4B. So to modify this example slightly, let's just pretend that the RMD itself is still $75,000. But instead of taking a distribution for $75,000, of which $30,000 went to a QCD, you decide to take a distribution of more than the RMD. You take $105,000 and you contribute it all to charity in the form of a QCD. Then what would be on this line right here? It would be $105,000. And what would be right here? It would be 0. Remember, enter 0 on line 4B if the full amount is a QCD. That's where your tax benefit is being taken into account, the difference between the amount of the distribution and the taxable amount of the distribution, which would be 0 if the entire thing went to a QCD. So you do not take an additional deduction related to the amount of the QCD in either of these two sections. And I really want to emphasize that point because I had someone recently tell me that they inserted a line somewhere in here and they were deducting the amount of the QCD. Wait just a second here. Let's check in with Waldo right here on this strategy. You did what now? Excuse me, you're saying that you reported a QCD. Let's continue with the same example as above, which was a $75,000 RMD, of which $30,000 was given to charity in the form of a QCD. So you're saying you reported a $30,000 QCD, so the taxable amount in line 4B was lower by $30,000, and then you deducted another $30,000 again on Schedule 1 or the charitable contributions line of your tax return? No. Okay, IRS, don't play that. The $30,000 is already avoiding tax because it is excluded from the taxable amount on line 4B of the tax return, as we have discussed several times now. You don't get to deduct that $30,000 again as a Schedule 1 deduction, as an itemized deduction, or as any deduction. Okay, that would be like the ultimate ultimate double counting. The money was never taxed going into the IRA, and now you want to take a tax deduction for donating money that was never taxed in the first place? Okay, no, you don't get that double whammy. Now you might say, well, wait a minute, I can donate appreciated stock from a regular brokerage to a charity and one, avoid tax on the appreciation or gain, while also two, taking a tax deduction for it. So how is this any different? Well, I'm going to give you two answers. Number one, in the appreciated stock example, you already paid tax on the initial investment portion of the security purchase. In other words, you purchased the appreciated securities in the first place with after-tax money. Conversely, everything in the IRA is all pre-tax money. So in the appreciated securities in a regular brokerage situation, the tax law does allow you a double whammy on the earnings part, but effectively not the principal part, because that was already taxed long ago before you even bought the securities. And then answer number two, which is less satisfying, but nonetheless still the law. The rules are just different for IRAs than for regular brokerage accounts. You don't get to exclude the money from your taxable income and then take a tax deduction for the same amount when we're talking about QCDs coming out of IRAs. So if you've been doing that, which I hope you have not, if you've been taking a double whammy on QCDs by number one, excluding them from line 4B of your tax return as in the example above, and then number two, taking them again as a tax deduction, then I highly recommend you get with a competent CPA in your area to assess your prior year tax returns firsthand and go over with you what may need to be done. So that's going to be it for today's video. Remember that sign up for my 2024 tax preparation class is now open. We're going to learn tax planning from inside the tax return as we prepare our 2024 filings. There is now a video FAQ about the class, and the link to watch those FAQs can be found in the description below this video. All right, that's it for today. Thanks everyone for watching, and I'll see you next time.